Welcome to The Explainer. Today, we're going to decode the fundamental rulebook that pretty much every single business runs on. I mean, it's the question at the heart of the whole business world, right? And the answer, well, it all comes down to a shared set of rules, a system designed to give us clarity and, most importantly, trust. All right, so here's our game plan. We're going to build this thing from the ground up, starting with the absolute foundation. Then we'll get into the rulebook itself, and finally, see how it all plays out in the real world. Okay, let's dive right in. We're going to start by laying the foundation, the 4 frameworks that support everything, and I mean everything in accounting. So, what's a framework? You can really think of it like the architectural blueprint for financial reporting. It's what ensures everyone is building from the same solid plan. So you've got these 4 pillars, right? There's the why, the whole point of it all. Then you have the actual laws that companies have to follow. After that, the guidance from official bodies to keep things consistent. And finally, the oversight from regulators. All 4 of these work together to create a system that's stable and, you guessed it, trustworthy. Okay, so we've laid the foundation. Now, let's move up a layer and look at the actual rulebook that gets used day in and day out. It's called GAAP. So what exactly is GAAP? It's basically the universal set of rules that make sure everything's uniform. And this is so important because it lets investors and, analysts reliably compare different companies. Everyone is playing by the same rules, which means we can actually compare apples to apples. Now, this is where it gets really interesting. GAAP isn't just one big blob of rules. It's actually split into 2 parts. You've got the core, non-negotiable concepts, and then you have the more practical, guiding conventions. So first up, let's dig into those bedrock assumptions. These are the concepts that accounting literally cannot function without, the unbreakable rules. Okay, as you can see, there are quite a few of these core concepts. We're not going to go through every single one, but let's just zoom in on 3 of them that really show you the logic behind the whole system. Okay, first, the entity concept. This one is super simple but crucial. It just means a business is its own separate person. So for example, if you own a coffee shop, the money you spend on your personal groceries is not a business expense. Why? Because the business is a completely separate financial entity. Next up, the going concern concept. This one's pretty straightforward too. It's just the basic assumption that a business is going to keep on, going. It's not about to shut down tomorrow. And this is exactly why accountants can carry asset values forward year after year. And this one is the big one, the dual aspect concept. It's the absolute foundation of all bookkeeping. All it means is that every single transaction has 2 sides that have to balance. You buy goods for cash, right? Well, that means receiving goods on one side and paying cash on the other. It always has to balance out. All right, so if the concepts are the hard and fast rules, what are conventions? Think of them as the traditions, the best practices, basically the pro tips that guide accountants in applying those rules wisely. Now, these conventions are all about making sure financial statements are prepared with a certain mindset. Take conservatism. That's the classic better safe than sorry approach. You account for all possible losses, but you don't count your chickens before they hatch, Then there's consistency, which just means you use the same methods year after year so things are comparable. And materiality, that's all about focusing on what actually matters. And finally, full disclosure means you have to be transparent about everything important, good or bad. Okay, theory time is over. Let's see how all this stuff actually applies to one of the most common and most crucial decisions in accounting, classifying spending. And this table just lays it out so clearly. The core difference is all about the time frame. Capital expenditure buys a long-term benefit. Think buying a new machine. It becomes an asset on your balance sheet. Revenue expenditure, on the other hand, pays for a short-term need, like your monthly rent. That's just an expense that goes on the income statement.
All right, time for a quick quiz to see if you've been paying attention. What about the wages you pay to your machine operators? Is that capital or is it revenue?
You got it. It's a revenue expenditure. It's a recurring cost you have to pay just to keep the normal business operations humming along. Okay, how about this one? What about the one-time cost to get a brand new production machine, one that's going to last for years, all set up and running in your factory? Capital or revenue? Yes, exactly. That is a capital expenditure. It's a non-recurring cost that's all part of acquiring and preparing an asset that's going to provide benefits for a long time. So, what's the big takeaway from all of this? It's that accounting isn't just a bunch of random rules. It's a really logical system. You have the four frameworks providing support. You have GAAP as the universal rulebook with its concepts and conventions. And all of that structure is what lets accountants make clear, consistent decisions every single day, like telling the difference between capital and revenue. So now you know the rules of the game. The question is, how does this change the way you'll look at the next financial headline? Because the next time you see a report about a company's spending or its profits, you'll have the framework to understand what's really going on behind the numbers.